We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Justin Huhn, founder and publisher of the Uranium Insider newsletter. How are you today, Justin?
Doing great. How about yourself, Tom?
Excellent. Good to have you back and chat a little bit about what's going on in the uranium space. I know it's been a little while since we've actually spoken last time in September here. So it would be great to kind of go over some of the updates for what has been happening in the uranium space. So why don't we kind of start by going through last week, Cameco had their quarterly conference call. They're one of their big calls of the start of the year here. So let's go through kind of what the developments were there.
Sure. Yeah. Last week on Wednesday, February 9th, Cameco had their Q4 conference call for 2021. And these are always really big events for the uranium space. Everybody pays attention to these events, nuclear industry, the investing space, et cetera. And when it comes to these conference calls, nobody's really paying attention to the actual earnings numbers. They're always trying to, read the tea leaves with what the company is saying. And so there were a couple of big announcements in this last conference call. One was the announcement of the official restart of the MacArthur River Mine. So MacArthur River is basically the largest uranium mine on the planet. It's huge, high-grade underground mine in Saskatchewan, Canada. And it's been on care and maintenance since 2018. Cameco took it offline because the prices were falling. They recognized there was still a lot of above ground inventory, circling around the uranium markets. And they wanted to pull that production offline as well as purchase from the spot market to fulfill their contracts rather than produce at a loss. And so that was a big turning point for the market and went a long way towards working through much of this above ground mobile inventory that they highlighted at the time. So now that they are restarting that mine, it was generally understood that the market would not perceive that as a bullish thing, right? I mean, when it obviously is, because they've been signaling to the market for years in every single conference call that MacArthur River will remain offline until they have a safe home for a good portion of future production from that mine, meaning long-term contracts signed. And so every conference call, they'll update on how many pounds they signed in long-term contracts of the previous quarter. And it's always, 10 here, 15 there. And so we would assume that their announcement of restarting would actually be a positive sign for the nuclear industry and for the market. And but of course, we expected that the market would interpret that as new supply coming back, and therefore, we're back to a flooded market, and that's absolutely not the case. So what they did was, in conjunction with that announcement, they announced that they've signed 70 million pounds in long-term contracts since the beginning of 2021, and 40 of those 70 million were in the first month of this year. So that's huge numbers. So they signed more long-term contracts in January than they did all of 2021. And, it still remains to be seen whether or not this is term contracts that would have been signed anyways from other entities looking to the West because of the unrest that's happening in Kazakhstan, or it was happening last month in Kazakhstan, or if it's actually a new uptick in term contracting, which is what I believe is happening and what the markets seem to believe is happening as well, judging by the reaction in the markets to that conference call.
Mm-hmm. Yeah, it seems like that the tide is really starting to turn for that long-term contracting cycle, right?
Right, for sure. Yeah, for many years, there's been an under contracting in terms of total pounds versus the annual burn rate of reactors, right? So you have, and it hasn't really necessarily been a destocking of inventories. It's been a bolstering of inventories through short and midterm contracts and spot market purchases and carry trades and such, not long-term contracts, which entities such as Cameco essentially need. They don't produce pounds to sell into the spot market. So they've been producing from Cigar Lake and from Inkai, a JV in Kazakhstan, for the past few years. And now that this mine is coming back online, MacArthur actually has a 70% offtake for Cameco and only 30% for Orano. So 70% of the pounds or probably more like 80 to 90% of the pounds coming out of that mine will never go to the spot market. All of Cameco's pounds will be going into term contracts. And then Orano, they do sell on the spot market, but not exclusively. They also have mid and long-term contracts as well. So yeah, it's and so for many years there were fewer pounds signed into long-term contracts than were actually burned through on an annual basis from natural demand from reactors globally. Now you had greater than the annual burn rate in term contracts happening during the previous bull market. So 06, 07, 08, 09. During those periods, we had really high volumes in long-term contracts. And then that has steadily declined since then, ticking back up slightly the past couple of years, but still far, far below what anyone would consider a real kind of bona fide long-term contracting cycle where we could see 250, 300 plus million pounds signed into contracts in a single year.
So, Justin, when we think about the dynamics of thinking about that news as a bearish sign for let's say the spot market, how long is it going to take for that plant to actually start producing, or that mine to actually start producing uranium once they make the decision to take it off of care and maintenance?
Well, they estimated they would actually produce around 5 million pounds this year, but most of that is coming from material that's already been mined, tails material that's being held in the mine currently. So they're not expecting much more than that for 2023, even when they actually get into mining new material. So it's going to take many months for the mine to get up and running. And then it's going to take many more months for that production to ramp up. So they expected about 5 million pounds 2023 and full production, which they're calling 15 million pounds in 2024. They also announced that they would be lowering the production from Cigar Lake from 18 million pounds to 15 million pounds. And I believe that both of these mines with the capacity of 18 million pounds, and actually MacArthur can do even more than that. I believe they're licensed at the Key Lake Mill for 24 million pounds a year. But for them to do both at 15 in 2024, I think that they're looking at efficiencies more than they are looking at all out producing as much as possible. There's probably, some production in that area of 15 million pounds a year that's max efficiency in terms of labor, in terms of inputs, et cetera.
Mm-hmm. Yeah. And I think that really goes to underline the fact that it's going to take years and years for, some of these projects to come online. That's an existing mine with existing infrastructure and, a company that hasn't had to step in and start things from scratch. And it's taking a year plus to get back to production, right? So that really speaks to the length of time it can take to get back into production, right?
Yeah, exactly. It's, uranium mines traditionally take a very, very long time to be discovered, developed, and then get into production. And of course, it depends on the type of mine. A mine like MacArthur River, from discovery to production was, we're talking decades. Of course, that's a very, very complex underground mine in an area where you have massive amounts of underground water aquifers. They're essentially mining in an aquifer. But of course, ISR mines are faster to develop. Open pit mines even are less complex in nature. So some mines can come on faster than others. And I think, but to your point, for us to have full production from this mine, not for another 24 months, really, and it's a mine on care and maintenance, it really goes to show how long it can take for supply to respond to the pricing environment. And as of now, we have yet to really see supply even respond to what's been, 50, 60% bump in spot price in the last 12 months. So, and then you talk about greenfield projects, projects that have mines that have never been produced before that are still in the developing stage. None of those are coming online in the short term. Mm-hmm. We might have some, 1 million pounds here, 1 million pounds there from some ISR stuff in the States. You have Paladin's Langer Heinrich on care and maintenance that we still need higher prices from here for them to consider opening that mine. They're actually getting pressure from their Chinese partner to start that mine back up earlier than they expect. We'll see how that goes. But it's going to be a very long time. We're talking years and years and years before we see meaningful supply response, especially from greenfield projects.
Mm-hmm. So, when we think about the long-term contracting cycle price versus the spot price, that's kind of a piece that's very unique to the uranium market. So how have those prices been reacting comparatively to each other? You mentioned that we've seen that spot price spike up over the last couple months here? And we'll get to, obviously one of the big catalysts for that price spike, but how have the long-term contract prices been reacting to that?
They've been on the rise, although the past few months it's been pretty stable. So the long-term prices were in the mid 30s when spot was in the high 20s, low 30s. So we had a classic contango market in that specific commodity. But what happened with Sprott coming into the market last summer, we had the spot prices vastly overshoot the term price, and over the course of about 3 months, kind of pull that term price up. The spot price did pull that term price up. So we went from 33, 34 a pound in July and August of last year, and now long-term price is sitting at $43 a pound. And so, and of course, that's the reported price. We never really hear the exact precise details of these contracts because they're almost always shrouded in mystery with NDAs. Mm-hmm. But the term price is on the rise, as is basically every element of the fuel cycle. SWU is on the rise. Conversion has sort of leveled off, but that is still near its highs. It spiked up really high a couple of years ago when ConverDyn shut down. But enrichment, like I said, SWU is on the rise, and of course U3O8 is on the rise. So basically all elements of the fuel cycle are in a bull trend, and the term price has responded. But interestingly, what's happening now is kind of that those midterm prices are pretty sticky here. They're not really moving up or down on any meaningful amount of volume. There seems to be somewhat motivated sellers in that price range. And of course, we have entities like Uranium One or Orano who have JVs in Kazakhstan that are producing at a pretty low price. And then we have BHP's Olympic Dam, which has uranium essentially as a byproduct of gold and copper production. They produce about 8 million pounds a year of uranium. And they do sell into the spot market, but they also do a bit of short and midterm contracting. So we have some players that are willing to sell midterm pounds in the low 40s here. So what's happening right now currently, just to not go too deep into it, but to give your audience a bit of color on what's adding liquidity to the spot market, is that we have pounds being held by carry traders. So traders that would sign a mid-term or long-term contract with a utility and then go into the spot market and source pounds and carry them on their books. So they would take into account the cost of capital, the cost of storage, their own profit margins, et cetera. And then they would sign that term contract with a utility. Then they're holding those pounds on their books for months, years at a time. And so what's happening now is a lot of these carry trades have been able to sell those carried pounds into the spot market at whatever price. So currently that's about $43.50 a pound, relatively speaking, and then roughly speaking. And then what you have is they've been able to cover those pounds by signing midterm contracts at a slight discount. So we have a very slightly backwardated market currently. That was severely backwardated last summer, August, September. We had the term price still in the mid, starting to climb into the mid to high 30s. And we had the spot price in the high 40s, low 50s. So that was a no-brainer trade for the carry traders. So there's been kind of some ongoing volumes going into the spot market coming from carried pounds being sold and being unwound into the spot market. And that has everything to do with there being a consistent bid in the spot market, primarily coming from the Sprott Physical Uranium Trust.
So just as you mentioned the Sprott Physical Uranium Trust, or SPUT there, Justin, how is their behavior going to look going ahead here? Are they one of those carry trade market participants? Are they going to be supplying these pounds back to the market at some point, or have they given any visibility onto what their plan actually will be with these pounds going forward?
Yes, they have. I mean, the visibility that Sprott is giving is that they will not be selling these pounds back into the market. This is a physical trust. So in the same way that their gold, silver, platinum, palladium trusts are, they literally just physically hold that material. And that vehicle is a means for investors to have exposure to the commodity. If they are trading in and out, technically, they could be doing that at a great profit, but that's not the purpose of this vehicle. The purpose of this vehicle is to be a repository and a holder of these physical pounds to give investors exposure to essentially owning uranium. Mm-hmm. That's really, if you want to own uranium as an investor, you're going to go out and buy some pounds from from Orano that are being held at Comurex in France and hold those pounds on your books, or are you just going to buy shares of SPUT in this extremely highly liquid, stock essentially? And so we've even seen, some hedge funds who have been holding physical, sell those pounds into the spot market and essentially exchange those for shares of SPUT because it's extremely liquid and there's far less risk than actually holding the physical uranium. Mm-hmm. So that's the purpose. And they do have management fees, right? They have, I think it's a 0.35% management fee plus a 1% fee when they buy uranium. So they're going to be, pulling in $10 to $20 million a year simply in these fees. And that's not nothing, but for an entity such as Sprott, that's not a whole lot of money, right? So what's the other motivation here? I think the other motivation here is one, to draw in high net worth investors to the space. That's one. So if they can offer their high net worth investor clients a vehicle for exposure to uranium, that's highly attractive for them. And B, they know very clearly that the movement of the spot price moves the equities. So now they are in the process of taking over URNM, the North Shore Global Mining Uranium Mining ETF. That is soon to become the Sprott Uranium Miners ETF. That shareholder vote is about 2 weeks from now, a little less than 2 weeks actually. And so after that, they will have these two highly liquid vehicles. They will have one that's exposure to the miners in the space via the ETF, and two, exposure to the metal. Money that goes into URNM, they hold SPUT. URA holds SPUT. Then you can invest directly into SPUT. And all of these things directly lead to purchases of physical uranium, which leads to the rising of the uranium price, which moves the equities. So they will essentially have a very large influence on the price of uranium going forward. And that, of course, moves the equities. And we know Sprott obviously themselves have pretty chunky positions in a number of the companies through years of financings. And so it's kind of this dual pronged approach: exposure to the miners, exposure to the physical, and they feed each other.
Are there any more developments with the New York Stock Exchange listing for SPUT coming here?
Well, the application is in. So there's not really any updates as of late, but the application has been filed. That was filed last month. At some point in the next couple of months, it's going to go through SEC review. It's going to have a public comment period that I believe is for a 3-week period, if I recall correctly. So in the meantime, it's highly likely that there's not going to be major fireworks and disruptions in the uranium market during this process, because obviously they hope to get that listing. That was part of the original reason, in my opinion, why they even went after Uranium Participation Corporation in the first place, was, a goal of having an NYSE listing like they do for their other trusts.
And just to bring that bigger chunk of liquidity into the market as well, right?
Correct. Yeah. It's far more liquid than the TSX. I think something to the tune of 13, 14x. And of course they would have the highly likelihood of having a listed options market as well, which would be huge for the trust and huge for the investing space.
So, Justin, you were recently on a trip to the field where you were speaking with a fuel buyer, and this kind of I wanted to ask you this as we're talking about the difference between the spot market and the long-term contracting market. So, what was his general sense of how tight the supply for the market is, and did his perspective kind of mirror yours in terms of how much available fuel there is to supply these utilities for this, let's say, this decade?
Yeah, I spoke with a number of domestic fuel buyers here in the States this past week. And I think that there were a lot of comments that were confirming of what we're seeing in the markets. There definitely is a pretty full awareness, at least amongst the fuel buyers that I spoke with, that the financial players are having a big influence on the uranium market. These particular fuel buyers are very sharp and kind of saw the writing on the wall and are pretty covered in their particular utilities. However, one that I spoke with, who was covered out through the life of the reactor, which is set to come offline later in the decade. Basically, I asked him directly, do you think that that your utility will get a life extension? He said yes, 100%. So now we're seeing domestic support coming from the federal government. If I recall, it was to the tune of around $6 billion to support life extensions for the existing reactors in the States. That's really positive. As far as the nuclear fuel market, the fuel buyers that I spoke with, they're not really worried. They're not really concerned, but they're recognizing a tightening in the market. One fuel buyer that I've spoken with over the past couple of years, this was even a year ago that he stated this was, if I were to describe the nuclear fuel market with one word, it'd be fragile. That was a year ago. That was before Sprott came online. That was before the unrest in Kazakhstan. And there's the spot market is thin. All right. So there's not a whole lot of above ground pounds just floating around the spot market. Now, the spot market is not a static vehicle. There's, like I mentioned, there's production that comes into the spot market, let's say 1.5 to maybe 2.5 million pounds a month from new production. That's coming from Orano, that's coming from Uranium One, it's coming from BHP, it's coming from the Uzbeks, it's coming from traders. Okay. So there's always going to be some material traded in and out of the spot market. It's not like there's this set amount, and once we're through it, that's it. That's not the case. But as far as relative to the demand that we're seeing, particularly from SPUT, who's purchased 4.6 million pounds this year already, they've already purchased far more than what would come into the spot market from new production this year alone. So it's pretty well understood by fuel buyers that the spot market is not the place to go to source pounds at this point, because they understand even a smaller amount of volume is actually moving the price up. And they don't want to move the price up because A, that moves the term price, which, if any utilities that are uncovered in the mid to the long term, they're keeping their eye on the term prices. And B, a lot of these utilities still have contract deliveries that are partially tied to the spot price. So to the extent that there's demand coming from utilities in the spot market, and there always is a little bit, but nothing meaningful here, then that moves the price. That affects the bottom lines of those deliveries. Mm-hmm. So it's basically pretty widely known that the spot market is thin in terms of high volume purchasing by utilities. The midterm market, like I said, I think is probably the most liquid. There's carry traded pounds that are coming into the spot. Then you have traders that are selling into the midterm, and you have the Kazakhs selling in the midterm. You have Uranium One, Orano, that have JVs in Kazakhstan selling in the midterm, BHP. So there's a decent amount of pounds in the midterm, and utilities are relatively covered in the short to the midterm. It's the long term that we're starting to see the utilities sort of wake up to. So to the extent that you're a nuclear utility and you have confidence that your reactor that you manage or reactors will be running out to the end of the decade and beyond, and you were uncovered during those time periods, those are the entities we're seeing come into the market and start to seek out long-term pounds. And that's also where the market is starting to get a little bit scarce. Mm-hmm. Cigar Lake is set to decline and end its production towards the end of the decade. MacArthur River will slow down towards the end of the decade. The Kazakhstan pounds are set to peak towards the end of the decade. So you have this period of time that's coming out into the late 2020s, into the early 2030s, where we need another Kazakhstan, essentially, possibly even two Kazakhstans to make up the expected gap in supply and demand, especially if the Chinese do follow through on their plans to add another 150 gigawatts of nuclear by 2035. Now we're seeing that France is planning on building 6 new very large EPR2 reactors. Those are 1,650 megawatts each. So what is that? That's another 10,000 megawatts from France alone. So, just major demand coming online towards the end of the decade and supply dwindling towards the end of the decade. So that's really the period that's driving the long-term contract interest. Mm-hmm. And then the short term is being driven by the financial interests. And then the midterm is sort of this vague area where utilities are mostly covered and there's still some decent liquidity. But that carry trade unwind I'm mentioning is pulling pounds from the midterm. Mm-hmm. So that's going to get tight at some point as well.
So you mentioned the US's $6 billion program to kind of extend some of the lifespan of some of these reactors. Does that give us good visibility on which reactors are going to be extended and how that affects the demand for the mid to long-term market as well?
I think honestly that it's going to be supportive of most reactors in the States that will come up against planned decommissioning. There are places like California where we have a highly politically contentious situation in terms of energy markets and renewables and things like that. We're already having suggestions from local and state governments to reduce power consumption during certain hours of the day. And that, in my opinion, is coming from not only just a larger amount of solar taking a larger percentage of the grid being taken up by solar, which continues to expand in California. And of course, at the time around where the sun sets is kind of the time where they're saying, hey, pull back on your energy usage. And then, of course, the same time where the sun is setting is the same time where people are plugging in their electric cars, which is, a relatively small percentage of all the cars on the road, but that's growing. Mm-hmm. So we're having, energy constraints in California. I'm in California, by the way. And we have one reactor remaining, which is Diablo Canyon. That reactor produces 10% of the power in the state. And I think it's 30-something% of the carbon-free energy. And that's set to come offline in 2024. There's obviously a lot of concerns locally around that plant because it's sitting on a fault line. When the plant was built, they knew that, of course. And, the operators of the plant believe that it's structurally sound. So that's, I'm not holding my breath for that one to be extended, regardless of financial support, because it's not really a financial reasoning for it to be shut down. It's more of a political thing. Anywhere where we're going to see reactors on the chopping block due to finance, I think that we'll see support for that, like we saw in Illinois. So we're seeing the Byron and Dresden plants in Illinois that were set to shut down in September of last year at the 11th hour. Got support to stay online. And now those plants are talking about getting 10-year life extensions that were set to shut down last year. So we're going to just see more and more of this. And even along with the France news of building 6 new reactors with the potential of adding an additional 8 to those 6, by the way, and putting funding towards SMR research. They're also saying that they plan to give life extensions to a lot of the older plants in France as well.
That's actually something that I wanted to move on and talk with you a bit about, Justin, is these SMRs coming onto the market, basically. So do you have any idea on how that could affect, whether positively or negatively, supply for fuel and as well as how far out some of these SMRs are from actually being produced and implemented to provide power?
I think at this point, it's really just too speculative to even say what the demand will look like coming from these. I think that there's a lot of very, very positive energy around SMRs in multiple countries. And that's really great to see. I think it's essentially only a positive thing on all fronts. It'll be positive for uranium demand from the investing side of things. It'll be positive from an embracing of nuclear. It'll be positive for the climate. The SMR designs that I've, looked into recently, they're far more efficient. They're smaller. So the uranium demand is not huge on an individual basis, right? Compared to a 650 megawatt EPR reactor that France is talking about building. These are, 50 to 500 megawatts. They're, and anywhere in between. They're much smaller. So the actual demand coming from, one here, one there is not that significant from a uranium demand perspective. But looking at the broad space, it's very exciting getting, out towards the end of the decade and into the 2030s. I don't expect it to really move anything in terms of our investments in the next, 2-3 years plus for this bull market. But it is one of these, growing positive support elements that's kind of in the backdrop of the overall fundamental picture. As far as timing goes, the reactor, the SMR that they're looking at building to implement in Wyoming, that's going to replace a coal plant, that they're looking for construction permits for 2023. And they believe that it will take 3 to 4 years to build. So they're, if everything goes smoothly, we're talking 2026, 2027 for that. And that would be the first SMR in North America to be, if it's connected to the grid and run online. So that's about the earliest that we're going to see. Now, of course, China's probably going to beat us to that. So we'll see what they're doing in China and abroad. Russia's building them. I mean, it's happening, and it's happening kind of all over. So it's super exciting. But as far as putting a number on demand, I think it's impossible to do at this point.
Absolutely. And that's kind of what I wanted to ask you is, how far out you think those SMRs are from actually coming to the market. So, Justin, in, let's say, September, October, we had a real run up in price, and obviously equities reacted to that very acutely as well. So how are you gauging sentiment at the moment? And what is the progression of sentiment changing along with the behavior of the institutions here?
I would say the sentiment is pretty low for the most part currently in the uranium market. It's improved over last month. I think that the Cameco conference call and seeing the market react to the restart of MacArthur and those long-term contracting numbers definitely helped. But overall, it's pretty low. It seems to be pretty doubtful. I think there's a lot of broad market influenced fears in general across the investing space. And that, of course, affects uranium, especially when we don't have a rip-roaring move in the spot price. When that happens, I think you could probably call uranium a quote unquote safe haven because the stocks will ignore everything else for the most part. So I would say the sentiment is majority negative here, but improving. Last month we were getting towards despondency. We had the equities pull off between 40 and 50% from their highs in November. But this is a time where we start to get extremely excited and kind of greedy. We just put on a new trade last week, an options trade, and we obviously, have a process for finding the stocks that we feel will perform the best in the space, and that's done pretty well for us so far. But we start to get really, really excited when the stocks pull off this much because we're in this for the long term. We're not swing traders. We have a 2 to 4 plus year outlook for this bull market. It could go faster. It could go slower. It could be, if we avoid a serious price spike scenario, we could have a very long-term bull market for uranium. That's entirely possible. But for us, we hold for the long term and we buy on weakness, essentially. Of course, we trade in and out of some positions as we divest of certain companies and add different companies. That has happened, a dozen times in the past year and a half or so, including options positions. But, we were chatting before we started the recording about Rick Rule, and I see a lot of comments, on Twitter for uranium investors coming from uranium investors that, they state that they're excited about the prices falling. And I think a lot of times, people just get tired of hearing that. And they think that, that's just somebody kind of trying to cope with their own psychological difficulties from a market that's pulling back. And I'm not poking fun at that at all. It's definitely not easy to weather drawdowns in investing. It's not just money. Most people have real earnings that they have put on the line in these investments from, years and many thousands of hours of their own life gone into earning that money they're investing. So, it's difficult. These markets are difficult. But when people say that on Twitter, it's kind of like, yeah, I doubt that you really feel that way. But when Rick Rule is like, you can see him just like frothing at the mouth when he's talking about stocks coming off 50% for something he's bullish on for the long term. So I'm excited to see him get excited again because he was thinking that things were overvalued last fall relative to the price of uranium. Maybe they were, maybe they weren't. Either way, here we are at 40% sale, 40% off sale. And Rick is actually hosting an event next month called the Uranium Investing Bootcamp. And I've been honored to be invited to speak at this. So I'll be presenting during this digital conference. And so there's some very exciting speakers that nobody's heard speak before. And so I highly suggest that your listeners check it out. And I don't have any money on the line with this particular conference. I'm not getting paid, not being paid to promote it or anything. I just think it's going to be a wonderful meeting of the minds to discuss this investment thesis.
Mm-hmm. Yeah, I remember the last time I spoke with Rick, he was really looking forward to this area here, February to March, to hopefully be able to catch up to some of the equities that he felt that he had in a way missed, towards the tail end of last year. So Justin, you had mentioned that uranium equities kind of at some points reacting like a safe haven here. Do you think that the uranium equities, some of these miners will react that same way in a general, a broad market crash here? Like, are they going to get drawn down like we see some of the silver miners, for example, some of these really sensitive equities that are going to get, pulled into a liquidity crunch along with the rest of the market?
Sure. Well, I wouldn't say that uranium has been a safe haven, relatively speaking, recently. Now, uranium did vastly outperform a very strong bull market in the broad markets last year. So you had URNM outperform the S&P by 4 to 5x. I don't remember the exact number, but last year, vast outperformance. But I wouldn't call that a safe haven because we were in a broad market bull market. So recently, there's definitely been outsized beta in terms of the performance of the uranium equities relative to the broad market. You had, during January, you had 1.5-2% down days in the S&P with 5-6-7% down days in the ETFs. That's a big down day for an ETF. So I would say, generally speaking, there's simply outsized beta. I mean, when the broad markets are moving down, and uranium is flat, when the commodity is flat and there's not a lot going, definitely people, when there's risk off, people sell what they own. It doesn't really matter what they own. And so we had the risk off in January and everything got hit for the most part, with an exception of oil, which was in a pretty strong bull market. But my theory on uranium as a safe haven has everything to do with the movement of the spot price. So if and when we get another strong upward movement in the spot price, I believe the uranium equities will follow suit, barring an all-out liquidity crisis. If we have a broad market crash, of course, I think everything gets hit in that environment. But if it's a choppy or relatively weak broad market and the spot market is ripping, I think that we see uranium equities move, along with the spot price.
Mm-hmm. So, Justin, how are you basically analyzing your cash position here within your portfolio to kind of act as a defensive play at this point?
We were 15% cash leading up into last week, and then we took a full-size position into the options trade. It's a vertical call spread, so it has some pretty good downside protection and still some good risk reward. It's about a 3.5 to 1 reward to risk, I should say. So now we're currently at 5% cash, but we're 15% in physical. So it feels somewhat defensive, but we don't really have acute concerns about a massive broad market crash, at least not in the short term. So we're comfortable with our level of investment, considering that we're holders for the long term.
Excellent, Justin. That was a great kind of wrap up and update on what's going on in the uranium market. Is there anything else you'd like to add before we do wrap up here?
I think that I would like to add that I think the market is underestimating the impacts of the news that Cameco shared. Mm-hmm. I think that it's entirely possible that we could see some serious long-term contracting numbers here, and the market should be watching out for that in terms of any sort of news about the Chinese continuing to sign term contracts and acquire projects. That would be a really big signal. And then, of course, I think that the market is also underestimating the impact going forward, especially starting in the second half of the year, of the financial players. So that's not only Sprott. We're talking about Yellowcake has already gotten shareholder approval to do their $100 million purchase from Kazatomprom. That will happen at some point this year. Then we have ANU Energy, which is a physical uranium fund that's being set up in Kazakhstan. They had the $50 million initial funding from Kazatomprom and essentially the National Bank of Kazakhstan. That happened late last year. They're expecting to do a $500 million follow-on raise. And there's unbelievable demand for energy investment in the East. And that's what this vehicle is being set up for. Plus we have Sprott, of course, the big player in the space. And Sprott is going after that NYSE listing. I think they get it, but I also think that regardless of how that application resolves itself, whether or not they get the NYSE listing, I think after that resolution of that application process, whether or not they get it, that's going to be kind of game on, really. So I think that we'll see a lot of financial interest in uranium, especially starting in the second half of the year. And in the meantime, they just continue to accumulate, continue to shake out those pounds from the carry trade. And so the market is tightening as we speak. And if you have an outlook for, let's say, at least a 2-year time frame, and you see what's going on in the markets currently, you really should be getting greedy and aggressive at these levels, in my opinion. And of course, if you invest in the right companies, you can do extremely, extremely well. Even though the equities they're far off the bottom, right? I mean, we're not in the first inning here. Mm-hmm. We're probably in the third or fourth inning. But those big moves come at the end of the game, as we all know.
Absolutely. Like David Morgan says I think it's something like 90% of the move comes in the last 30% of the bull market, right?
Correct. Yep.
When we get some of that euphoria come into the market, especially that we have seen before in the previous uranium bull market. Absolutely.
So yeah, I'm pleased to see the market kind of reset here, the uranium market reset, and see some what looks like to be a bottoming formation.
Mm-hmm. Excellent, Justin. Of course, you're available basically everywhere at Uranium Insider, on Twitter, and of course, uraniuminsider.com. Justin, thanks so much for your time today.
My pleasure, Tom. Thanks for having me again.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.